Good morning. For the first hour of this session, I will introduce you to the world of accounting, auditing, and financial reporting. We will introduce you to the basic accounting and auditing principles, compare them against some of the legal ones, and discuss what happens when auditors as gatekeepers fail to uncover financial irregularities, financial misstatement, and financial fraud, and then who really gets blamed in the corporation for the failures. I will then take you through many of the elements of tangible risk that you're going to face as fiduciaries and stewards of the company. The next session will be presented by Dr. Michael Creighton, an expert on sustainability and sustainability reporting, who will take you on your next journey on how to measure enterprise risk. In this portion of the session, he will explore tangible risks and how to evaluate them financially. Our next session, Modules 4 through 8, will focus on intangible risk and the types of risks that you will also need to face in your careers within the modern corporation or as outside advisors. These are the risks that do not appear on the balance sheet or financial statements, but like reputational capital, can easily destroy the value of a corporation and far faster and far greater than any asset on a company's balance sheet. So let's begin with our journey in an introduction to accounting and the role that accountants and auditors play as we explore the basics of financial reporting. Many of you have seen the movie Accountant, at least I hope you would. In fact, I'd urge many of you to look at it, not just for the actors, but for the story plot, which is becoming more and more a common occurrence and is based on a number of real financial frauds that have taken place over the years. And just a slight diversion, one of the more endearing one-liners about traditional accountants was told by Milton Berle of Ed Sullivan fame in the genre of the 60s live TV shows. Milton Berle described the traditional accountant that is all in our minds. The company accountant, says Berle, the company accountant is shy and retiring. He's shy $250,000, and that's why he's retiring. Let's first discuss the underlying rules that provide the basis for financial statement preparation. Financial statements of an enterprise, or what the enterprise purports to be the true financial and operating condition of the corporation. As you know, financial statements are prepared by management. Auditors of public companies review them and present an opinion on their fairness, and the corporate counsel advises management on the legality of the disclosure. The underlying rules and concepts and guidelines for financial statement preparation is known as GAAP, Generally Accepted Accounting Principles, and for auditors it's known as GAS, Generally Accepted Auditing Standards. But what are they? Well, the accounting coach folks identify 10 basic accounting principles and guidelines, which they argue constitutes the basis of GAAP, Generally Accepted Accounting Principles. So I think this is a really good place to start. I really do think they do a very good job of distilling the principles down to 10. The first principle is that the company, and when I use the term company, I'm generally referring to the 5,000 publicly traded corporations on stock exchanges throughout the world. And as we discussed before, the company is a single economic and legal entity and is responsible for reporting its economic activities. The corporate accountant is responsible for recording and presenting these activities, and in summary form through creation of the company's financial statements. Management is ultimately responsible for the financials of the corporate entity. And generally there are inside or internal financials that only corporate executives review, and there are outside or publicly available financials that the public and the investor and the shareholders and the stakeholders is available for viewing. The second principle that accounting coach folks identify is monetary. The folks at Accounting Coach identify economic activity as measured in a currency, whether it is in dollars and pounds. And one of the issues for global companies, frankly, and of course, is currency fluctuation throughout their global operations. Many large companies hedge against currency fluctuation. And as an enterprise risk manager or as advisor, one of your duties might be to assess whether by hedging against currency fluctuation risk, you are not in fact increasing the overall exposure and the risk of the company, or conversely, reducing the opportunity to achieve profit gains on currency fluctuations. When Lehman Brothers went bust, in fact, they were hedging with repurchase agreements, Repos 105. Had someone in corporate counsel looked at the agreement with the counterparty side of the repurchase agreement, they would have realized they were not allowed legally to spend that kind of money and invest that kind of money in repurchase agreements around the world. The problem was during the weekend, some of those counterparties went bankrupt, which also caused Lehman Brothers to go bankrupt. Someone in corporate counsel, someone in risk management should have read the memo that limited the exposure of Lehman Brothers. They did not. The auditors missed it. Management ignored it. And Lehman Brothers precipitated the Great Recession and a $30 trillion decline in the wealth of people all around the world. Time period. The third assumption from the accounting coach folks is that accounting measures equal intervals over time. And for consistency, relevancy, and the opportunity to compare growth or decline over an identical period of time, this is absolutely critical. In some of the major frauds, using a cutoff, say, of 12/31XX, it's been shown that there was an incredible opportunity by using a specific cutoff date to manipulate the financials. In one case with General Electric, there was they used a term in fraud called channel stuffing, accelerating the shipping of goods at year end, regardless of what the normal shipping cycle is. For example, many of the goods that were supposed to be shipped in the subsequent January period were accelerated back into December, when accountants recognized the revenue on the shipment. And many companies like GE and others got tagged for channel stuffing. It generates higher profits in the year that the product is shipped and greater compensation for the executives. Something you're going to have to watch, the fluctuations at year end. Cost principle. Principally, this involves a manufacturing environment where cost is what companies pay for their goods and is recorded at the price they paid for them when they bought them. In periods of low inflation, not an issue. In periods of high inflation, tremendous issue. What is the cost of the goods in inventory? Full disclosure. Financial statements should not hide liabilities or disclose issues of a material nature. 6. Going concern. As we will discuss later, this assumption is open to tremendous interpretation. However, GAAP accounting assumes that a company will continue to exist. The outside auditor supposedly makes a call on the company when he or she releases the audited statements, or to the SEC or to other regulatory bodies, that at least the company is a going concern. And in most cases, they generally say for the next 12 months. Matching principle. Revenue of an enterprise, or the cash it receives for goods and services, needs to be matched against liabilities or obligations of the company to produce the products or services that were bought or contracted for. This area is probably one of the greatest area for financial manipulation, of course. For example, in the $3 billion Halliburton fraud, a colleague of mine, Tony Menendez, their CFO, who was a whistleblower, identified the $3 billion of equipment sales, was recognized as revenue in 1 year, even though the services for which you used the equipment were not actually provided into future years. Halliburton recognized the $3 billion of product, but they didn't recognize the $3 billion of services where they had to install these pieces of equipment, principally in the exploration area. Nor were the costs of the services recognized until years later as well. 8. Revenue recognition. The easiest way to describe this is when you buy a 3-year subscription to a magazine or Netflix subscription, or commit to buying an iPhone or Android and pay for it over a 3-year period. It could be argued by the phone company that all the revenue should be recognized when you sign the contract. Maybe only 2% will default. It could also be argued that the revenue should be recognized over the 3-year period and matched against the service obligation to provide these telecommunication services, also over a 3-year period. GAAP rules require revenue to be recognized over the period that you provide the services. It also highlights the rules of conservatism, which is designed to protect the shareholder, investor, or the stakeholder who relies on these statements. Well, this at least was the traditional historic role, and we're going to discuss this a little later too. Materiality. One of the basic principles is that financial statements need to disclose critically important items of a company. And as we'll see later, every regulatory body and even the Supreme Court has come out with different definitions of what constitutes materiality. In fact, one might question whether materiality relates to the company as a whole or just to the critical and material change in a balance sheet line item. For example, if the company was doing currency hedging and every year made $3 million on it, but this year lost $3 million, is that material to the company, or is it material to the line item on a comparable basis in prior years within the financials? Does it need to be disclosed? Is this line item important to the materiality of the financials? If it does need to be disclosed, who makes the call? And if it's not disclosed, who in corporate counsel or risk management or as an outside advisor gets tagged for not making the call? This is an important item. For example, at AIG, which was the largest global bankruptcy in history, on the Hong Kong trading desk, there was one trader that bet badly. And do you remember the wolf or the hound, or I forget what they call the person in London when he made a bad bet? It was one item on one line item of a financial statement that was significant and material to the whole financial stability of the company. Conservatism. As mentioned, it is assumed that accountants are conservative folks and that they would rather underreport activities than overstate activities. In fact, if you look at the earnings calls, when people exceed the expectations, but in the prior periods understate or reduce the expectations, that's when the stock makes the biggest move. The folks found that, and this is study after study, that they'd rather underreport activities than overstate results. It is defensiveness that most accountants actually adhere to. The question, of course, is when the CEO wants to provide more aggressive numbers, and remember the accountant as the auditor is paid by the company, hired by the CEO, how independent can the auditor be? How conservative can he or she be if he or she risks losing the audit engagement and their huge related fees? Before going into my perspective now of GAAP, I'd like to provide a little background for the regulatory structure in the world of finance as it regards financial reporting. The regulatory structure for accountants and auditors and financial managers is a complex quilt of organizations, standard setters, regulators, and international agencies that oversee financial reporting. As I will mention later, trillions of dollars cross borders every day, but the accounting for those trillions depends on numerous regulatory bodies, standard setters, and rules and principles that in fact globally have never been harmonized. Quickly, some of the players are the FASB, the Financial Accounting Standards Board. We're going to discuss them a little later. They purport to make accounting rules in the states. They are located in Stamford, Connecticut. They're also related to the GASB, the Government Accounting Standards Board, but because of lobby pressures, I would argue over the years, commercial accounting standards were just too tough for state and local governments and municipalities to handle, so they just created their own organization called the GASB. And it's why you can see a balanced budget in the city of Chicago, but not see unfunded pension and healthcare liabilities in the Windy City in the tune of billions of dollars. Then there's FASABI, which is the Federal Accounting Standards Board, which governs accounting for the federal government. And incidentally, the General Accountancy Office, the Accountability Office of the federal government, repeatedly has said that neither the Federal Reserve nor the Department of the Army was auditable under these government accounting standards. Now, when you think of the top 52 multinational global companies, that, of course, as I mentioned, are the largest of 52 of the 100 economies of the world. Outside the states are a number of standard setters and accounting standards. There's IFARS, which is the International Accounting Standards Board in the EU. They create them. And incidentally, international rules are basically principles-based, underlying ethical principles which are used to determine that the financials that are reported are truthful, accurate, and free of misstatement. Our GAAP is rules-based, and as we will discover later, there are many rules governing the handling of an identical transaction. Then there's the new Sustainability Standards Board, not official, but it's SASB, the Sustainability Accounting Standards Board out in California, underwritten by Michael Bloomberg, which is attempting to develop sustainability measures in 147 different industry sectors. And we're going to discuss that a little later when we talk about sustainability reporting. On the auditing side, auditing used to be written by the AICPA, the American Institute of Certified Public Accountants. That is the trade and professional organization of licensed certified public accountants in the United States. Very similar to lawyers, in fact, in the ABA. However, a separate entity within AICPA actually made the rules, and the industry for many, many years was self-regulated by AICPA. But after the global failure of companies and their auditors with the Great Recession, and their failure to prevent, detect, and uncover fraudulent financial reporting, material misstatement, errors, and omissions on financial reporting, auditing and self-regulation was stripped away from the accounting profession and was put under an entity called the Public Company Accounting Oversight Board. It was established as a semi-independent organization with some oversight by the Securities and Exchange Commission. The PCAOB, as it's known, codified the auditing standards of the AICPA and others, and is now over 3,300 pages of rules and standards and principles. And finally, for public companies, the SEC weighs in on both GAAP reporting and non-GAAP reporting. And a lot of studies have been completed on how public companies report results, and today the majority of companies actually report on a non-GAAP basis. And not surprisingly, non-GAAP reporting by the CEOs tended to overstate GAAP financials, in some cases by over 50%. And losses on a GAAP basis turned into record profits on a non-GAAP basis. My slide on non-GAAP measures under section G of the SEC of non-GAAP, not GAAP, anti-GAAP, and GAAP measures is pretty revealing on how creative companies can be using GAAP, non-GAAP, not GAAP, and if you would believe it, anti-GAAP measures. Now let's do a deep dive into my perspective of generally accepted accounting procedures.